Morning, everyone. Thanks very much for joining us for the Liberty 2 Degrees pre-close update hosted by Avior. Please ensure that your microphones are muted for the duration of the call. We will get to a Q&A segment and give you the opportunity to ask your questions verbally if you'd like to. We have the executive management team with us already dialed in from Liberty 2 Degrees. I believe that we'll also have the chairperson dialing in, Mr. Angus Band. If there are any questions that are best aimed at the non-executive directors of Liberty 2 Degrees, we're going to leave those to the last quarter of the presentation and just deal with them then. I'm going to hand over to Amelia to give us a bit of a preamble. There has been an update published via Sense in the last hour. Amelia, if you could just give us a bit of color regarding what the content of that update was, and then we'll go into a Q&A session. Over to you.
Thank you, Daniel, and good morning and welcome to the pre-close investor update ahead of our year-end close period, which commences on the 1st of December. It's Black Friday and we are presenting here from Sandton City, where the queues are already very long with many excited shoppers. And I hope that you all get what's on your Black Friday wish list. Warren Buffett said, in the business world, the rearview mirror is always clearer than the windshield. As we close out 2020 and move into 2021, nothing could be truer than that. We all know how 2020 played out now. However, a lot of uncertainty remains about 2021 and our tomorrow. What is important is that we stay focused on what we set out to do in rebuilding our business for growth. And that is exactly what we continue to do every day. We went into 2020 with a clear plan, and then we needed to adjust ourselves very quickly to get through the storms of this year during the COVID-19 pandemic. We needed to have agility in swiftly adapting to new ways of thinking and working, ensuring that our teams go back to basics in focusing on strong property fundamentals in the quality assets that we have, whilst continuing to focus on the communities in which we operate through our precinct focus and building block strategy. Our new ABC for rebuilding for growth is anchored in that. I would like to summarize the three key messages of this update. Firstly, our balance sheet. We have ruthlessly protected our strongest asset, our balance sheet, that was able to support our efforts, where we could hold hands with our tenants, our service providers, and our people, and step forward together, and most importantly, remained with an LTV of 20%, one of the lowest in the sector. Secondly, the quality of our assets. For me, it's not about the story of the super regional versus the community mall or the neighborhood center. It's about the quality of the actual asset. And if that asset is able to offer customers what they want, so that they return to spend their share of the wallets. Assets that provide experiential offerings combined with convenience, those are the assets of the future. We have 81% of the foot count back in our malls at the end of October, and we had 83% of the turnover back at the end of September. And it's nice to see how these things go hand in hand. The third message is around our strategic building blocks that are clear. We have been executing these and will continue to do so to keep our assets at the forefront of the ever-changing retail environment, and in so doing, rebuild our business for growth. All of our malls achieved the COVID-19 Global Compliance Certification issued by Safe Shopping Centres, and safe spaces underpin our operational strategy now on an ongoing basis. For the month of October, the portfolio foot count, as I said, recovered to 81% of the 2019 levels, with the top performers being Midlands, where 98% of people returned, and at Eastgate, 96%. If we look at weekends specifically, where the South African customers love to go to malls during the weekend, we had 93% of the foot count back during the month of October. The clear winners here were East 8% and Midlands at 103, and at Sandton we've seen close on 87% of the feet returning. You just have to walk around the centres to see that people are back at their favourite malls. We're also pleased to note the continuing positive trend in the monthly turnover, with September at 83% of the 2019 turnover. If we look at the rolling 12 months number, that is at 81% for the 12 months before that. And Sandton and Eastgate are both aligned to that number, and we have Botshabelo that are actually 10% up on a rolling annual basis on the previous year. The portfolio has seen a steady improvement in turnover as the lockdown levels have eased, allowing our retailers to resume trading and drawing customers back to the retail offerings that we have. In fact, today, on Black Friday, there are so many new offerings that are opening and that our customers, I'm sure, will love to go and see. The top 3 performing categories in this last quarter, from a turnover growth perspective, were luxury brands, groceries and supermarkets, not unexpected, and technology, also something that we have seen across the industry. Luxury brands, though, play a significant role in our portfolio that contribute around 8% of the total turnover and only less than 1% of the GLA. If you come to Sandton City and you come down the long escalator, you always see queues in the Diamond Walk, especially around Louis Vuitton, whether it's a Tuesday or a Friday or a Sunday. The category was negatively impacted in the second quarter because they were unable to trade during lockdown level 5, but they had a significant recovery driven by the pent-up demand of the local customers. From a hospitality point of view, the Sandton Sun is currently our only hotel in the portfolio that is operational, and it has been showing steady growth in occupancy with around 30% in September. The convention centre, we could also open in November for the presidential conferences that have taken place, and we have now been able to open and close the convention centre depending on the demand that we see. It is important to remember that our portfolio's exposure in the very high percentage of retail of over 80%, together with our hospitality assets, were impacted worse than all other sectors and therefore took longer to return to full trading. It therefore did have an impact on our performance for 2020. However, it is very encouraging to note that the L2D share has significantly outperformed the SAPI index on a year-to-date basis. If we move on to vacancies, our retail vacancy is at 4.7% at the end of October, and mainly due to some increased vacancies we've seen at Eastgate, previously occupied by House and Home and Mr. Price Home that moved upstairs into the new space. Our leasing team made good headway, and they secured a further 900 square meters of new tenants, which will reduce the Eastgate vacancy from now on forward. Forever 21, as we all knew, at NMS closed officially in September, and the leasing team has already secured new tenants for around 80% of the space. You would recall I said in earlier updates that it's a very busy bridge that goes over from Sandton to NMS, and therefore they could get new tenants for that space. If we take all that into account, the retail vacancy is at 3.7%. This remains well below the SAPOA retail vacancy rate of Q2 of 5.6%, and I'm sure we'll see would have increased in Q3. Our office vacancy is at 15%. If we take the pre-lets into account, that will reduce to 12.2%. And the most impacted assets include Melrose Arch due to the take-back of a large portion of the Standard building and also the NMS offices. Liberty 2 Degrees will move office in the first quarter to the NMS offices in the first quarter of 2021, which will further reduce the vacancy at Nelson Mandela Square and also bolster confidence in the space available for letting. Our new office will be a true example of how we can integrate new ways of working into this precinct and retail environment. Our overall vacancy is therefore at 76% at the end of October. Rental collections and the rental relief updates everyone wants to know about is that we base our rental collection number on the full amounts due before we deduct any of the rental relief, and that is increased to 84% from 74% when we last presented. The improvement is the result of the successful conclusion of the additional rental relief negotiations and the fact that almost all the tenants are now trading. We expect the total position of arrears to improve as we close out the final rental relief in the next couple of weeks or week or two so that we can close the year end. Rental relief negotiations from a tenant perspective for the Q2 period are 77% complete if we take the number of tenants, and ongoing negotiations take place every day with a balance to ensure that we create sustainable businesses going forward. I am deeply appreciative for the work of our teams on the ground every day that continue to close these out and run the businesses as they prepare for the festive season. If we look at our community-focused strategies and in executing our smart spaces building block, we envisage a significant increase in the technology deployed in our business and by extension, its influence in how we run our business and how we implement our digital strategy. As I previously reported, we appointed Patrick Masitela as our Chief Information Officer, and he has made good progress in driving the Smart Spaces initiatives. In recognition of the centrality of enhanced data capabilities to deliver on those experiences, our major focus in this area is in developing the relevant data capabilities that will fuel the achievement of our strategic goals. You would have seen some of that in Andrew Tarver's presentation that he did in our Investor Thought Leadership Day, and some of our work is based on that. The specific initiatives that we are pursuing is the further development of the AWS data lake, which we had already employed in the first quarter, the optimizing of our internal use of data so as to free our teams to do more quality work in furtherance of our enhanced experience aspirations. We have also initiated the Smart Cameras initiative through which we will deploy artificial intelligence-driven processes to better understand the behavior of customers where they are inside our malls. And of course, all of this takes place with due consideration to Popeye. We are also in the process of developing an engagement platform geared at providing relevant asset-level experiences to create convenience for our customers. And we will be extending this platform to our tenants in due course. As part of providing greater convenience to customers, we will also be automating our gift cards in 2021. Good Spaces is our other building block, remains focused on delivering our net zero 2030 aspirations. While there has been excellent progress in many areas, COVID-19 has had a negative impact on our ability to be net zero waste ready by the end of 2020, and we will delay this a little bit until we are fully prepared in 2021. LTD became a supporting member of the South African Plastics Pact initiative and the first participating landlord to work towards a common vision for a circular economy for plastics. Eastgate recently completed the Piazza upgrade, which included solar trees and also a solar farm, which will be commissioned shortly. If you are nearby Eastgate, go and have a look at those trees. They are really magnificent. The solar farm is expected to generate nearly 2 million kilowatt hours of electricity in the first year of operation. Generation capacity will be used to power lifts, air conditioning units, and our escalators. To create a deeper focus on the experiential offerings in our business, we have combined the three other building blocks that we had: on-demand spaces, inclusive and immersive spaces, and we created a new umbrella called interactive spaces. This is an opportunity for an interchange of ideas and experiences with an emphasis on interaction of fast-paced, exciting, and experiences that create places for customers to come back to. That this will also incorporate the work that was previously done in the individual building blocks to make sure that we create an enhanced customer experience. The malls in the LTD portfolio recently were awarded 32 of the Footprint Marketing Awards by the South African Council of Shopping Centres. If I move on to our trading statement that is also included in our update today, and that we want to draw your attention to the withdrawal of our 2020 distribution guidance, as well as the previous statements that we issued. As we previously reported, the COVID-19 pandemic and the secondary effects of the pandemic on the economy is having a severe impact on our 2020 financial results. And as noted in our previous statements, distributable earnings will be negatively impacted. I want to remind you of the statement that I made earlier around the over 80% of retail plus the hospitality exposure that also impact on this. So we would like to advise you that based on that expected decrease in distributable earnings, we have reasonable certainty that our DPS for the year will be lower by between 55 and 65%. Our board will consider the payment of a final distribution for the 2020 financial year once our full year results are finalized, and the regulatory requirements for the 75% payments will be taken into account. So in closing, we've made good progress in negotiating the rental relief packages and are seeing a monthly improvement in both foot count and turnover, as I shared with you. We remain very focused on our ongoing response to COVID-19 and the strategy that we are implementing in order to rebuild our business for growth. I am reminded of the words of the founder of Liberty, Donald Gordon, at the opening of the Gibbs Business School in the year 2000. But today, as we move from 2020 to 2021, they are as powerful. He said, "Become the most positive and enthusiastic person. Passion in business is everything. Watch for big problems. They disguise big opportunities. Limited funds are a blessing, not a curse. Nothing encourages creative thinking in quite the same way. And isn't that what 2020 was really all about? Don't waste time responding to your critics and be bold and courageous." With those words, I would like to also thank you all for equal amounts of challenge and support during 2020. I wish you and your family a blessed and festive season and a very well-deserved break, and may you all stay healthy. We enter a closed period on the 1st of December next week, and we will see you again on Monday, the 22nd of February, when our full year results will be released. Thank you, Daniel.
Thank you very much for that. For the dial-in participants, we're going to move to a Q&A session now. So the procedure is you have two options. If you've got a question, you can type your question into the meeting chat, and then I'll read it out for you. Or if you want to ask your question verbally, just click on that hand-shaped icon. And when we get to your point in the queue, you can unmute yourself. But before then, please do keep your microphones muted. There is quite a high number of people on the call right now. So I'm going to kick off the Q&A session on the DPS guidance. I just think it will be helpful to reconcile those assumptions a bit more precisely. Certainly, the DPS guidance came in below my anticipated level because it seems to imply almost no improvement in operating conditions in the second half of the year relative to the first half of the year. So it would be helpful if you could just at least roughly reconcile that guidance to the amount of rent relief which was provided in the first half of the year versus the second half, your bad debt assumptions, average vacancies, and maybe even the cost of debt, because the full year number seems to imply a range of a deterioration to flat. relative to the first half of the year?
I think I'll just give the narrative around it, and Jose can just do the details. I think it's important to remember that the first half only had 3 months of the lockdown in there. The lockdown then extended much longer, so the second half had only all the tenants started back up and trading again by the end of September, when we went into level 1, and we still have some of our hotels that are not back as a result of the international travel not really opening up. So I think that's important to keep that as a backdrop, that not everything happened in the first half of the year. There was significant impact of COVID-19 on the second half of our results, but perhaps Jose could give some details on the numbers.
Yeah. Morning, everyone. Thanks, Amelia. Daniel, I think it's exactly that. The first half only had 3 months of impact, and the first 3 months of the year was relatively good compared to the prior year. The second half, we've continued to see impact in the hotels that remain closed. All the tenants in the hospitality area and the restaurants have remained largely impacted by COVID up until now. The restaurants activity we've seen in the last month or two have started improving gradually, and we're seeing significant uplift now over the start, I guess, of the festive period. I think it's also important to note that whilst tenant discounts were applied for the hard lockdown period, there was continued negotiation with tenants, and especially with our reversion numbers, when you see them for leases that were renewed this year, have been negatively impacted by income as well. So it's largely, I guess, the second half of the year didn't have a hard lockdown period that one can reference, but a big part of the portfolio remains severely impacted, and most notably, I guess, is the hotels, the convention center, where there was no income. Turnover rental, for all intent and purposes, this year is going to be gone. Parking income has gone significantly for 9 months of the year. Just the first 3 months really saw normal levels of parking income. And lastly, our cost increases remain quite high. You'll see when we present our final year results that the utility costs are still in the double-digit growth rates compared to the prior period, which also would have had some impact. Thanks.
Thank you very much. A question from Mwesho from SPG asking, can I confirm the 55 to 65% decline is on dividend per share and not distributable earnings per share? He states, I only ask as you're still deciding your final payout ratio.
Daniel, yeah, we'll declare the final dividend when our board meets in February, make the final decision around the full year dividend. So that number is on distributable earnings. If we wanted to distribute 100%, that's where the range would be. The decision as to how much we are going to distribute is still to be made. Thanks.
Yeah, thank you. I think you've answered the second question from Wesho. He asked, it seems that with the DPS guidance that your like-for-like number got worse from H1 20. Just asking you to confirm that. And what proportion of the gross rentals were given away in the way of rent relief?
I don't think we'll probably in our year-end investor presentation give detail of exactly what was given away. There is a bit of provisioning in the current numbers that we've taken into account. We haven't concluded all of the negotiation with all tenants. I think what has been important for us is to keep the vacancies down, to keep tenants in operation. It has been a year in which we've engaged tenants probably more than ever before in understanding how they are doing in our centres specifically. And we haven't given, in my opinion, more away than we've needed to. So there is a bit of provisioning, and maybe that'll improve towards the end of the year in those numbers. But I'm not going to give away the exact amount of discounts given, deferments done until the end of the year and our final results are published. Thanks.
Thank you. Question from Nessie asking for some more insight into trading densities, how they're looking across the various shopping centres. Nessie comments that we saw some soft Stats SA retail sales numbers, especially from apparel, while other furniture and appliances were up. So how are your apparel tenants doing across your portfolio? That's the first question.
So we saw this week that MSCI put out the third quarter trading density numbers. I'm firmly of the belief that trading density now as a measure is not a good measure, because we don't have all the tenants trading. You didn't have them all trade for the same period. So it's better to look at the turnover growth numbers, because it actually tell you how much turnover is generated out of a mall and out of your different categories. However, our trading densities still remain significantly more than what is happening in the rest of the industry. Of course, the same softening has happened in some of the retailers that have not been able to trade, but I don't think there is anything in our mall that you see looking very differently from what you would see across the industry, other than the luxury tenants doing incredibly well. And then some of our apparel tenants that have been doing good sales out of these malls, because they have a wider range of offerings. So people can come here and get more of the things that we offer here. I think that is where super regional really is so different from a mall down in your neighborhood, where you don't really go there to go and shop for the things that you want to wear in December. You rather come to a place where there's a bigger variety, and we see that coming through in the turnover of our apparel tenants.
Thank you. Maybe just a follow-up from my side. You've quoted a footfall number which is to the end of October. I realize it's not strictly comparable to the turnover number, but they seem to be in a similar range, 81% footfall versus 83% turnover. Is it fair to say that the basket size impact is not that meaningful, not moving the needle that much against the footfall decline?
Yeah, I think it is quite encouraging to see how these things are starting to track together. And you've seen it in the earlier days of return, more people returning spending less, and you start to see the opposite of that happening as we as more and more of these tenants have opened, and as more of the people have returned. So we expect those things to recover together. What I can tell you is that October numbers are certainly looking good. We just haven't had all the numbers in, but the early indications of it is that we've seen some good trading in October.
Thank you. And Nessie's also asking for a general comment on your expectation for reversions in the retail sector in 2021. He's asking whether we are through the worst or not, in your view.
I don't think we are through the worst, because the secondary impact of COVID-19 will have a longer tail than what we had expected, and we'll certainly see some negative reversions as we go into 2021. What is important is that we deal those things on a case-by-case basis. There's not a blanket brush that you can brush across even a category of tenants. So within the categories, certain tenants will trade better, can sustain a slightly higher CCO ratio, and others would need help for a little bit longer. So our philosophy has been to create a sustainable tenant base into the future. So where we think it is needed to help a tenant for a little bit longer, to get them onto their feet, to get them back to a positive trading in their own profits environment, we'll help them for a little bit longer, and we'll perhaps step it up a little bit higher. We take a higher age, so when they recover, there's some upside for both parties. So it's been a very much individual negotiation position, where we've taken one-on-one negotiations with tenants to do the best that we can for the tenants that we have, so that we can keep our vacancies down and we can keep them trading, so that we have these malls full when customers come, and there's a variety of experience for our customers.
Thank you. Question from Ridwan asking, with the LTV at 20%, is a reduced payout ratio up for consideration at all?
Daniel, I think most people know that the SA REIT industry had asked the JSE and the regulators for relaxation around payout ratios for this year. That request has been denied. So at minimum, we'll have to pay out 75%, and we're considering the balance, which we'll decide on finally at our year end. But we are in the fortunate position that we do have a low LTV, and it's probably leaning towards a higher payout ratio than a lower one with a minimum of 75.
Okay, thank you. Question from Keelan from Sanlib. What are the plans for the space vacated by Prada and LC Waikiki at Sandton City, for example?
So Prada space gives us it's a large space, so it gives us an opportunity to cut that box up, and we have something that is temporarily going to open there on the 3rd of December, just to trade through the festive season. And as the new year comes, there is demand for smaller boxes into that space that will anchor this side of the Diamond Walk and bring some new, fresh tenancies in there. LC Waikiki, there's already been a tenant that has indicated some interest from inside the mall. It's prime space. It sits in a really great mall with good visibility, and I am confident that the teams will be able to close that out as soon as they can. Unfortunately, this has been the trend of international retailers not having, if they don't have enough stores in South Africa, having just one or two for them just is difficult in this environment. And it's the same story with Prada than with LC Waikiki. They just couldn't see themselves continuing in South Africa. So it's not a Sandton specific issue.
Thanks. Question from Bundy. Can you talk about the sustainability of your rents at Sandton and Eastgate, which are more than 440 Rand a square meter in a post-COVID world?
Daniel, when we entered into these negotiations with tenants on their discounts for this year, a lot of times the discussion went on to tenants that had reversions coming up, and in severe cases there were even discussions around rebasing in-force leases where a tenant's business was going to fall over and the rents are unsustainable. So what you'll see is that in comparing this year to last and probably forecast for next year, there's a lot of negative reversions coming through in the portfolio, and these are driven not only by I guess the COVID impact, but by looking at in detail the sustainability of that tenant's rents versus its operational performance in our centres specifically. So a direct consequence of it has been that a lot of reversions are negative, and we think it's probably going to be negative into next year as well. And that speaks to the sustainability of the individual tenants and then overall the assets and the portfolio. So we do believe that where we are now is sustainable, but you are going to see a negative impact on reversions, I think, for at least the next year or two.
Thank you. Another one from Bundy on the balance sheet. Are you seeing opportunities to scale up in SA given the deep discounts to NAV and the healthy balance sheet?
I think we continue to look for opportunity, and we've been in discussions with people continuously for as long as I've been at L2D around the potential of a merger or not, or buying assets, etc. I think there is still a deep disconnect between what people want for assets and what the assets are doing. And in an environment where you're not sure how tenants are going to survive for the next year or two, it makes it even more difficult. I think it's more complicated now than it was 12 months ago to consider an asset acquisition or a corporate activity. So we continue to look. If the right thing comes up, we'll do something.
Just maybe, Daniel, can I add to that? Our balance sheet is a real strength for us, and it gives us the ability to, one, look after our tenants to make sure that we can create a sustainable tenant base, but also to look after our own assets with that. You know, we continue to maintain our assets well. We don't have to scale back on not doing maintenance and the things that are required to manage a property portfolio well. And the balance sheet is not only there for new opportunities, but it's also to look after what we have.
Thank you. Thanks. We've got a question from Paolo from Clearance asking, could you talk to the valuations going into year end? Given the deterioration post H1, are you expecting further valuation declines?
Yeah, there is going to be an impact on the valuations. I don't think it'll be anywhere as significant as what it was at the end of the first half of the year. What we didn't expect into the second half, a lot of impact into the second half was expected at that time and it was factored into the valuations. What we didn't expect was how long it would have taken for international travel to return, and for, I guess, the tourist market to start re-engaging in South Africa. So we think there'll be a bigger impact going into year-end valuations on the hospitality assets again compared to the retail, and also a bit of offset in the retail where there was a lot more uncertainty at the mid-year valuations. You can now start seeing activity returning and those assets, I guess, performing better than what was expected at mid-year. So there'll be a bit of offset, I guess, in the retail assets and probably downside in the hospitality assets. But overall, the portfolio, there will be an impact, probably slightly negative, but we'll disclose that at year end. But definitely not as severe as what has occurred at mid-year.
Thank you. Amelia, we have two questions from Kundai and Bandi. The same question, really. I think probably best aimed at Angus regarding the special LTIP award recently announced. The question basically is to just take us through the board's thinking, the rationale for that that special award.
Okay, good morning, thank you. I just drafted a short précis of the board's thinking, which I'll take you through, and maybe it will address that question. The background to the SENS announcement last week relating to our incentive schemes was that the board tasked the RemCo with assessing whether, in the light of the impact of the pandemic on L2D, our incentives were still effective in driving performance, as well as maintaining, retaining, and motivating the management team. The RemCo looked at various scenarios and concluded that, on balance, potentially at risk, as the company had only been listed for a relatively short period and the incentive schemes had not resulted in any material lockup on management. It would therefore be relatively inexpensive to recruit members of our management team by competitors. Consequently, it was decided to leave the existing long-term and short-term incentive schemes in place, as the RemCo felt that it was inappropriate to change these schemes that had been implemented previously. No change has been made to the term or vesting conditions in respect of the existing long-term schemes, and the targets in the short-term scheme for 2020 also remain unchanged. It was, however, considered appropriate to make a one-off award of restricted shares to try and ensure that the retention risk of the management team was mitigated. This allocation has been made to 17 managers, with the allocation ranging from 15% to 100% of guaranteed pay. And the vesting is in line with the existing LTI scheme, which is 1/3 equally over years 3 to 5. The performance conditions have been modified to take account of the uncertain times, but are directly linked to the recovery plan, which has been covered by Amelia. The RemCo will assess the progress made on the 4 strategic building blocks in the execution of the strategy, and in addition, participants must achieve a fully achieved individual rating over the 5 years. The board approved this proposal on the basis that it clearly aligns management with the delivery of the recovery plan for shareholders and reduces flight risk by increasing management's value at play in L2D, but subject to what we believe are appropriate performance conditions.
Thank you. Thanks, Angus. Are you able to share with us some detail regarding what you consider to be the peer group when assessing the level of remuneration for Liberty 2 Degrees executive team in comparison to others?
You mean the group that we've benchmarked against?
Yes.
We've looked at a group of attack, Hyprop,
Vukile,
Resilient,
Resilient.
and then we've also looked generally at the sector as a whole. But obviously, those with big external exposures may have a different profile.
Okay, thank you very much. We don't have any more questions coming through the chat on that specific issue. Just a reminder, you feel free to type in your questions into the meeting chat. I'll read them out for you, or you can ask your question verbally as well. You just need to click on the hand-shaped icon and we can unmute you when we get to your point in the queue. For the time being, I'm going to ask you a question on the strength of the balance sheet. I think to both Amelia and Jose maybe, but I'm particularly interested in the possibilities, the future possibilities in terms of your relationship with the Liberty Group, because as far as I understand it, Liberty policyholders have the option to redeem their exposure daily, and also potentially have the option to manipulate their underlying asset allocation, typically. And I'm interested in what their incentive is to remain exposed to the direct Liberty property portfolio when they could take an exposure to the listed property market at a seemingly big discounts to NAV. Does it not provide an arbitrage opportunity for them, and doesn't it present a risk to your balance sheet in future? Is that something that you're thinking about in terms of the conservatism of your LTV, and you know, whether you may have to consider further acquisitions of the LPP in future?
So I want to take you back to 2018, and what we've done then to address this in part was for Liberty to cancel the put that they had for basically L2D to buy the assets that they could put at us, and that was an important issue to resolve for us, so that we have an ability to, as L2D, make the commercial decisions to buy the assets that we want to buy at the time that we want to buy them. The Liberty property portfolio, as you rightly say, are owned 1/3 by ourselves and 2/3 by Liberty. And we, in this business, are focused on doing what's right for L2D and L2D shareholders. So where we believe it is good for us to buy an asset, if they want to sell that asset, we will assess that asset, we will determine what would be the best price, and we will do so if that's the right thing to do. Up to now, it's not been something that we've been needing to do, and it is an engagement that we internally have all the time, you know, because we like these assets, we know them, we understand them. We would like to have more of them, but it's important that if we do that, we do it at the right price, and we do it so it's in the interest of L2D. However, Liberty deals with how they manage their balance sheet. They themselves have a very, very competent and experienced management team to decide on what's the best course of action for them. And we can't influence that, and we don't make those decisions. We can only do what's right for this business and do the best we can for our shareholders.
Okay, thanks, Amelia. We haven't discussed the office portfolio so much yet. I'm interested in two things there. Firstly, the attitude of office tenants in your experience over the last 6 months with respect to lease expiries. How are those being handled in the year to date? Is there a tendency in terms of your renewal success rate and the renewal lease length? Are there cases in which you've moved to month leases until there's more certainty? Just a little bit more information on that would be useful.
I think our office portfolio, as you know, is like a small part of our overall exposure. However, it is something that's been very much front of mind of the teams over this last time, and I think it's a little bit of all those things that you are managing. So you get tenants that are here and that want to stay in the environments, and if their leases come up, they would negotiate in however world that they find themselves in. There are people that have left that will not be returning to an office environment, and not only with us, but also elsewhere. As you also will be aware, our big tower at Sandton is one of the only places in the wider Sandton where you can have small pockets of space. You don't have to take a whole and the tenancy is such that we can deal with smaller tenants, and that's been an opportunity that the teams could work on. And I did note that Melrose Arch has been particularly impacted, and some large users have vacated there. But we do see new tenants coming that need new space. I mean, Nelson Mandela Square had some new tenants move in there. We are moving in there. And I think there's a little bit of, if a tenant needs to be on month to month so that we can see how they recover, then we will work on that and put a firm date to that. But there has been good leasing activity that has been taking place. We obviously have all the incentives in place to bring tenants to these environments. And we're hoping that as things settle down and businesses return to the office, which will happen at some point, not everyone's going to work at home forever, but there's a lot of uncertainty around COVID. So many people don't want to commit now to new long-term arrangements around offices, and we'll have to work with that imperfect information, with that uncertainty for the time being, until such time that we know what the world's going to look like and how we can, in some cases, change the offices to something else, and in some other cases, put tenants in a different way.
Thank you. And could you just remind us roughly your exposure to Standard Bank as an office tenant and Liberty as an office tenant, and the lease expiry profile of those specific tenants currently?
We have Standard Bank in the city. I don't know the percentages. Maybe Jose has that, or Jonathan's also on the call. But we've got Standard Bank in the city of Johannesburg. Certainly, we know that Standard Bank has no intention of vacating those offices. They are consolidating their position and they need those office space. That lease has been fairly recently renewed, so there's not early renewal pressure on that. We've sold the Century City building where Liberty was a tenant of ours, and Liberty is a tenant of ours in Umhlanga. And at this point, certainly no indication that they are going to exit that office, and that lease has also been renewed fairly recently. So I don't believe there are Standard Bank or Liberty risk in our tenant profile.
Have any notable office tenants approached you with the intention to cancel the lease for a fee?
Not anything that's significant that will have a significant impact on us.
Okay, thank you. A question from David coming through the chat asking, what is the % of retail tenants that are currently on month-to-month leases?
That's a number that is not on our update today. We will see if we can disclose that in the full year number. It was normally in our full year presentation. But it's not a significant number of our tenants by GLA that is on month to month. Most of our tenants have leases in place, and you know, we've been negotiating with them in terms of the rental relief packages, and where we deem it appropriate to have a tenant on month to month for whatever reason, we would do that. But we will make sure that we manage the risks appropriately so that somebody can. That we understand the impact of it and do whatever is needed to retain the tenants.
Thank you. Another kind of question related to the office segment is I guess it's retail actually. The retail trading statistics which you disclosed an aggregate number and a weekend trade number, which looked like it's improving, but it seems to imply that the weekday experience is still more difficult, and perhaps that might be related to the office nodes being relatively empty. Is it possible for you to just be a bit more precise about what the experience is year on year for weekday trade, and what you think you can achieve heading into the festive season?
I think you are quite right that where a centre is dependent on large office exposure around it during the week, they will be impacted by the weekend trade, not the weekday trade not being back. And we don't have the specific numbers in there, but if the weekends are up more than the average, then the weekdays are down. During festive season, more people are on holiday. We do understand from the trends that not as many people will go on holiday, so a lot more people will be staying home. You just have to come to Nelson Mandela Square any day during the week, any evening, late afternoons. People are back at the restaurants. They're coming to the restaurants as they used to, whether it's weekend or weekday. And during the week, we certainly can see the foot count starting to pick up. Schools are closing. The matrics have finished exams. Most schools are closing early next week. That will bring some people back. So it's a combination of it. And in the end, yes, we need to get people in here, but it's important indicator for us to track is the turnover. And as we can get the turnover back up, that is what is driving the confidence of tenants to be in the place and to be able to pay their rental. So it's not just one of those, it's a combination of all the indicators to ensure that we drive the spend back here.
Okay, thank you. One more question from my side, and then we're going to give an opportunity for any last questions. Please submit them via the chat if you have them currently, or you can click on the hand-shaped icon. We're going to wrap up in the next 8 minutes. But from my side, perhaps for Jose, if I recall correctly, the first half of the year distributable earnings figure, or let's say the operating profit figure for the purposes of distributable earnings was mismatched relative to the operating cash flow figure, as far as I recall, something like 73 million rand, and that was on the basis of ongoing tenant negotiations, which you were confident would be settled at some point. Could you provide an update on the arrears that were experienced at the end of the interim period relative to where you are now, and whether that has evolved in the way that you expected?
Yeah, Daniel, we are, with our mid-year expectation and the arrears position that we had, and I guess the provision that we made for settling on some of those positions with tenants, we are still within what we had anticipated at that point in time, probably about 5% better than where we were at mid-year. We have seen, I guess, further deterioration from that point, specifically on the hotels. We anticipated the hotels would be opening towards the end of the third quarter of this year, whereas the reality is they are going to remain closed, or a large component of them, well into next year. So that has been, I guess, where we missed the mark, was on the hotels. But as far as the discount to the retailers and offices are concerned, we are within where we wanted to be. What we have seen, as expected, was that as you close out these deals, the guys settle their arrears position. Not everybody goes into complete arrears. There's varying stages, I guess, or some tenants don't pay at all, some pay their utilities, etc., and some pay part rental. But what we have insisted on is, in closing out these deals, that they settle their arrears position, and we have seen that happen in the second half of the year.
Okay. Amelia, if you'd like to make any final comments, you can make them now. We don't have any questions that have come through yet. Would you like to say anything further?
Thank you, Daniel. Thank you for hosting us today. Everyone on the call, I don't have any. I've made my closing remarks. So if there are any other questions, we'd be happy to answer them for you separately if you need them. Gareth,
Thank you.
You can just direct them to Gareth. He will resolve them for you.
Thank you to the executive team and to the chairperson for joining us. That was very helpful. And have a great Friday, everyone, and a great weekend. And you can log off now. Thanks all.
Thank you.
Thanks all.